everyone. Welcome back to the Prospero AI Stock Market live streams. It is Monday, May 13th, and boy, do we have a lot to discuss today. The meme stock craze is back. We will get into all of it and what's going on with GameStop, some of the other smaller meme stocks that are affected by what's been going on in the markets today. As always, I'll take you through the topics to lead off our show, and then we'll get into them as George joins us in here. If you're new here, be sure to like and subscribe. If this is not your first show, comment. I love to see people rejoining our streams. Welcome back again. But like I said, Roaring Kitty posted for the first time in nearly 3 years on social media, and he sparked a new wave in this meme craze saga that's been going on for multiple years now. So we'll discuss that and everything that means. The market seems to be taking a little bit more risk on today, at least in the morning. And like always, we'll talk about some developments in the AI world. We have SoftBank's ARM making an announcement they're going to be making new AI chips in 2025. And we also have Apple nearing a deal to include OpenAI's ChatGPT in their iOS and iPhone 16s going forward. And it was thought by some investors in the market that maybe Google's Gemini would be the AI product to be included in the iPhones, but it's looking not like it now. And I think Google stock was down slightly this morning because of that new announcement we got today. I see 20 people in here. Let's see if we could get to 20 likes on this live stream before it's over today. We've only done that one other time in the past. So like it up. Thank you if you do. But let's see if we could hit that milestone today. Okay, so the next story is going to be playing into the maybe more risk-on meme stock trend we're seeing going on in the market today, where zero-day options hit their highest volume of 2024 last week. So we'll talk about what zero-day options are if you're not sure, and what that means, why investors may be looking at these products for their investing portfolios. They're on the riskier end of the spectrum, so we'll get into all of that. And then, you know what, let me lower this a bit. There we go. We'll talk about McDonald's, which is one of the companies that was able to raise their prices for a few years now, and maybe seeing consumers begin to choose to stay away from their menu and their prices now that they've been raised. They're thinking about adding a new $5 meal back into their stores to try and draw in these lower end consumers who were voting with their wallets and staying away from McDonald's over the past couple of months. We'll talk about that, what that means for their business. If we can see, or if we will see more businesses going forward begin to strategize and maybe even lower prices going forward. Next, another inflationary story that I'm sure some people have felt the effects of if they've been trying to buy a home in recent years. We're going to take you through the median home value. Hello, George. Good to see you in here. Just a few more topics to go over. We have 27 people in here now, but just hold on 1 second and we'll begin discussing what's going on in the market today. But like I was saying, home values will take you through 1965 through today, how much they've risen. It's kind of astonishing, and what that means. Maybe investors should be investing in real estate based on the numbers we'll share. And last but not least, we talk about Disney a lot, but today we're going to talk about another content streaming company that's coming under fire because they're going to be losing, looks like they're going to be losing their biggest asset, the NBA. So we'll talk about which company that is and what companies could be acquiring the NBA rights. But George, if we want to begin where, surprising news this morning when I opened my app and then looked on CNBC and was reading the news, and Roaring Kitty posted for the first time in 3 years, and he lit a spark today. The meme stock rally seems to just come up again out of nowhere. I think GME was up and GameStop was up over 100% at one point this morning. But can you take us through that and what's going on with the whole meme stock craze this morning?
I am going to get a live look at where it is. I mean, it has been nuts. And of course, like all the other like GME started running, and then like I don't know, like I was probably like a basket of stuff at the hedge funds. Like I almost I don't trade anyhow. AMC is doing super well now too. Um, I haven't traded in a while because I don't really like to do that. I don't want complicated questions about my portfolio picks, but I almost just quietly and not telling anyone bought some GME and AMC calls today, just because it's in the air. Of course, that's about as positive as I'm going to say about it. Now I will do all of my traditional caveats, and I definitely got in to AMC very early, and I was involved in the AMC trade. A lot of early Prospero users I met through that trade, and what I'll say about it is that the biggest thing is it's kind of become the antithesis of what people wanted it to be, which is some Wall Street revolution. Why is it the opposite of that? Because basically the best suited people to make money off these things are institutions. And a lot of the times people are just like, why would they short the stocks? It's like, well, Occam's razor. Why would they short the stocks? Because most people that are shorting these stocks also have call options, and they're good either way. Either they get these call options really cheap, and either it goes up and they make money, or it goes down and they make money. They've set it up, and when people make these runs, a lot of people, large institutions, make money buying a bunch of the shares and lending them out as shorts, and then sometimes at some time later, it is what happened with short squeeze, pulling those shares from loans. So that forces people to cover, and that's when you get kind of some of these big movements. But the problem is that humans are the ones that are really at a disadvantage against robots in anything like this, but especially the meme stocks, right? Because there's not like you can say, oh, at a certain price, it's no longer a good value, because it's not really a good value from the standpoint of traditional metrics from the start. GME has a 33 profitability rating and a 10 growth rating in Prospero. So there's not really a lot to it that you can discuss value wise. So all of it becomes social sentiment. And then it's just like, well, who has the best way to put their finger on social sentiment? Computers, right? Computers, and then computers also know how to get out really fast. When the tide is changing, they can swing trade it. So these are pretty much the perfect trades for institutions to make money now, because a lot of them even have social media operations to help control retail investors. And a lot of these hedge funds before like employ philosophers, psychologists to work with computer science people to make algorithms that best confuse people, that best put them in the position to make money. So unfortunately, at this point, it's become the complete opposite of what retail investors want. All these retail investors that have held GME all this time, AMC, a lot of them consider themselves revolutionaries, but really all you're doing is keeping alive trades that are better suited for institutions to make money. Because even if we're not talking about just the algorithms, they're in better position to get out quickly when the tide changes, as well as move the price, as well as all of these things that computers, you process all of the social media data, really understand what the trends are there across the whole internet. Computers are much better at doing that. But beyond that, there's situations at the brokerage. A lot of people use Robinhood, these payment for order flow things, that even if you do time it right and say, this is the good time to sell, you might get 20%, 30% worse execution than the institutions if things are going the other way, which if you're probably saying, hey, this game of musical chairs might be over, that's probably what's happening. So yeah, it becomes a very tough proposition.
Okay, so a few follow-ups to that. So, from all I can understand today, like why this all happened or got started today was that user Roaring Kitty posted a meme of a gamer sitting forward in a chair, kind of signaling like he was intently watching something developing in the market. And obviously, he was the original one with the GameStop move back in the day. Um, and you're talking about it from an institutional side. So, do you think he is connected with them somehow, or are they just using him somehow? They see like he's
No, I
posted
think
and they
I
know
think
people
they're using
react
the
to it.
same proxies. They're using the same proxies, right? I think everybody's looking at similar sources, right? They see a critical mass of social data. You can see it right on Prospero. Like it's like I haven't looked at it like this morning, but at close on Friday it was 86 option sentiment, 82 social sentiment. So it was already gathering. Yeah, now it's 100 option sentiment GME after open. So, oh wow, and 71 upsides. They're playing the long-term options. Now, of course, that's not necessarily people that or at least I'm thinking they don't believe in it long-term, but you can see when they start moving into these different options contracts and how sensitive Prospero is to that. But yeah, they're all looking at the same data, seeing a critical mass of social sentiment, a critical mass of options bets kind of mounting as people see this coming through the pipe. And that's what happens. And we can actually fit this in to what we were talking about in our newsletter, which is just like, well, what is the reason that institutions would want to do this? What is juice this trade, pump it up, anything like that? Well, because it's very hard to make the market so choppy. It's hard to make money in other places. And that's kind of the same market conditions when these things started happening in the first place. And like, yeah, these meme stocks, especially because they're well suited for computers and people with more data to make money than the people that propagate them, retail investors. Then you have a situation that it's very easy for institutions to get to pump these trades, right? Because they actually frequently will make more money on the way down because they're buying out of the money put options on the way up. That on the long-term markets that eventually pay out on these things. What goes up must come down. And if you buy them out long enough as an institution, you feel pretty safe that when you see something like this happen, it's going to lose the juice eventually, especially with AMC, which is a company that dilutes itself so much. But like, yeah, these trades when they started, some hedge funds got screwed, or plenty of them got screwed, but plenty of them made money on the first GME thing. And since then, they've been profit centers for these institutions, not sticking it to institutions.
So what's crazy? It's like it's been multiple years now since this whole thing started. I guess there's people still shorting the same stock. That's the only reason it was able to go up 100% today, I would think. So are these stocks ever going to lose, this like meme stock appeal, or is this going to hold on to with these companies for like? It seems very sticky. I guess I'm trying to say, like, with these, even though their businesses haven't improved at all, maybe have gotten worse. Years later, they're
There's
still meme
cult,
stocks.
there's cults involved in these companies now, right? So the cults keep buying the stock as it goes down, even though the value metrics really aren't there, right? And then people keep shorting them, right? Because that's really what should be happening from a value perspective, right? And then they just will buy out of the money call options, the same institutions that short them, and they don't care. Either the shorts cash in and they pay so little on the calls that it doesn't matter. Or this catches and they close their shorts quickly and their calls are money machines. So I think that like that's why. And again, like this is why institutions love this trade, because they like retail investors, it's very easy for them to miss the inflection point before it's going to go back down. And it's very easy for them to miss kind of the entrance when it starts going up. But institutions like obviously have automated trading operations that are very good at doing exactly just that. So retail's just basically on an ongoing basis setting up conditions for institutions to make money on the way up and the way down. So they love these trades, and a lot of them, do a lot to keep these communities alive, because they keep these communities alive. They keep saying, oh, like, the hedgies are FUCK, FUKT. then it kind of keeps people buying. It keeps the hedge funds love those stories to propagate, because the most difficult thing for a hedge fund vis-a-vis retail traders is for them to sneak up on them, try a new thing, and come in mass, right? So what's the best thing? What's the opposite best thing of that? Like, to keep them in a trade that they know exactly how to play for as long as possible. And unfortunately, there's a lot of willing participants in being institutional stooges on the retail side. And that's not to say there's no money to be made here, especially for savvy traders that know how to exit. But not only is that not the majority of people that are making money, the majority of people, so many people have held, right? And held as it's gone down, down, down. But there's that added issue that we keep talking about, where it's just like they keep this cult stuff alive. It's everybody who doesn't really know what they're talking about saying like the investment is still alive, and that's even the more dangerous thing than not getting out at the top. Getting your money caught in something that has no real future that you're going to hold regardless. That's what you really see with these people. And that's the unfortunate thing. GameStop could go to 100, 200, and a lot of these people would stick in until it's back down to $10.
Yeah, that is the problem. But we are seeing some kind of I feel like reaction going on in the market right now where the meme stocks are hard today. The Russell is the best performing index so far today. Crypto is up. I was reading a story about how 0-day options trading volume was the highest in 2024 so far last week. And we're seeing the markets kind of edge their way back to all-time highs. Do you think some investors who maybe haven't been able to capitalize on the gains so far this year are going risk on and trying to like capture all those gains quickly? Is that what kind of we're seeing this dynamic play out?
Yeah, I mean, I think the issue that happens with these things is that um, people ultimately think they're better than they are, and have some success, and that's what 0-day options are for. And they might have some right guesses, and then it's like any casino, right? It's the same concept where you get someone in, you make them feel smart, and then they just keep coming back to the well. And the bottom line is nobody should be trading 0-day options because of the exact problem we're talking about. Computers know exactly when it's a good time to trade them. And most of the time, these institutions are selling them, not buying them. It's much better to sell risk, especially the riskier the risk, the better off you are selling it than buying it. And then, even if they do take a position on this, their algorithms know very well when it's time to bail. And people don't. They'll watch the value go down to zero. They'll also watch them expire worthless all the time. And it's just one of those things that you don't know until like you just don't know until you're wrong. And institutions are really like, they love these kinds of things because there's a winner and loser in every trade. And the bottom line is you might have them on a day or two, but the majority of the time these things are not going to work out well because you're not like such a short-term trade requires the ability to process so much more price data than a person can relative to a computer. You're just even if you're really good at it, you're setting yourself up against some entity that is better than you, can process more than you, is getting different information, more information, and it's just not a smart game to play. And it's something that like is kind of surprising because like you hear institutional people talk about 0-day options, and a lot of them will like laugh at retail traders for doing it because there's plenty of institutional traders that wouldn't touch them years and years of experience and they wouldn't touch them just because they're just like the risk profile is so high. And the bottom line is like you might think you know why you're right or wrong or have a read on it, but the data set that you're using is not the right data set. There's much better data sets. Your brain can't process the data set that you need to compete with computers.
And comment from Saucepot Sassbox, it's like Dogecoin millionaire who lost everything because he kept holding as a principal. LOL. Yeah, it's unfortunate for him. Just spinning or diving more in depth on this topic, I believe, if I'm not mistaken, people on Robinhood, and I don't know if it's every brokerage, can trade options with no kind of test or any kind of, needing to prove themselves as an investor trader. Do you think there should become some kind of standard where you need to pass something, get certified, especially for something like 0-day options to be able to trade stuff like that?
Oh yeah, absolutely. With especially 0-day options. I mean, they're supposed to like, and people do ask questions about it when they do it, but they're supposed to like actually like it's very easy to see like you can lie about your experience, blah blah blah. It's very easy for people to game those systems. There's supposed to be deeper checks. And yeah, I think that there absolutely should be, a mandatory exam. It doesn't have to be super long, but like there's so many people that are trading options that don't even know the basic fundamentals of options, and that just shouldn't be the case. Like, and Robinhood makes it very easy to do spreads, but it just shouldn't be the case. It's crazy.
Agreed. We'll see what happens. in the coming years if anything goes on with that. We're going to get into some AI topics now. By the way, we have a decent amount of people in here. If there's a topic we don't get to or just something you want to hear us discuss today, just feel free to comment it. We're happy to discuss it. But as you guys are typing, hopefully, we'll get into our next topic, which is SoftBank's ARM, which IPO'd, I believe, last year, announced they're going to be making a new AI chip to come in 2025, where they'll have a prototype by the spring, and it's expected to be in mass production by the fall. And if you guys follow us on our socials, we posted a little short this morning about 3 stocks you could buy and hold for the next 10 years, and they were the cloud providers. And we hinted or explained why NVIDIA didn't make the list, and it was kind of competition and some fears with China. But does this announcement kind of play into that? And, just all of the companies that NVIDIA is competing with to maintain their share in this AI chip market?
Yeah, I mean, it's obviously a concern. I mean, one thing that we say with NVIDIA is prove it first. If you can, there's a lot of people that have been trying to beat their chips for a long time. I mean, they posted an amazing quarter last quarter, and there was a lot of people that said that, it went down and, out of China concerns, even though they were up 236% year over year sales. So I think that is a very interesting thing worth monitoring, where it's just there are so many threats out there against NVIDIA, so many people coming for them, that it's hard to not say, okay, there's some risk that they don't maintain this dominance. But there's the other side of the coin, and what makes that, it's one of the things that makes NVIDIA such a hard company to value is these places have been coming to them. China would love to invent a chip that's as good. And a lot of companies, AMD has pursued different strategies, but it's such a growth market that a lot of people are expanding. So that's also good for NVIDIA. But yeah, that is kind of the weird existential question when you're talking about NVIDIA, where it's just it seems like all of these smart companies trying to make something of similar quality to them, someone should be able to do it sooner or later. But the other side to that is that sooner or later hasn't really happened as long as these people have been trying to do it. So it's a very tough thing to odds make, but that's why we always say as good as NVIDIA is, that's why we trust kind of the cloud providers, Microsoft, Google, Amazon, better than NVIDIA over the next 10 years, because we just don't see the same, even possible existential threats to the business that NVIDIA has.
Do you have any specific thoughts about ARM? I feel like we kind of don't talk about them as much as some of the other chip companies, maybe because they're a newer IPO and maybe since they're an international-based stock. But it seems like they have a pretty massive scaled business, and they're kind of leading on the tech as well alongside NVIDIA. Would you invest in them possibly going forward? Do you have any special thoughts or insights about that company? Or I guess I'm just trying to dig deep on ARM because we don't really talk about them much.
Let's look at ARM's PE. Forward PE. Yeah, I mean, here's the thing about ARM, and this is what happens IPOs versus more mature companies. 2025 PE, ARM is 117. And then if you look at SMCI, let's check it out. I believe it's going to be a good, 2024 SMCI is 3783, right? And this is one of the reasons we love SMCI, because ARM kind of has that new company IPO excitement around it. But I'm just that's the one thing that we know why we don't really talk about it, because it's kind of an in-between. It's a newer company that's really high growth potential, but then you're just okay, it's got high growth potential, but NVIDIA is also growing as well as we've seen any company, even smaller companies, grow a lot of the time. So if you want the growth story, why wouldn't you take that? And then if you want kind of if you want the growth profitability story, you can kind of take NVIDIA. But if you want something that's a little less established, that is actually cheaper than NVIDIA, but not growing as much, SMCI is the obvious choice. So I think that's one of the reasons that we don't really I do think it got a little overpriced in the IPO, so it makes it much less interesting to me. And then it's we kind of got we kind of got our stalwarts there. And like, yeah, you're right. We kind of go scraping the bottom of the barrel a little bit sometimes. If you're talking about like, ASML or AV, Broadcom, ASML, Taiwan Semi, we own those all, have all times. I believe we might own them all right now in our trading portfolio. But yeah, you look at ARM and it's just not the same from a value perspective of any of those. So it's just like a lot of the times, like, Eli Lilly has a pretty elevated PE. I think last I checked, it was in the like mid 60s, still half of what ARM is on 2025. But we like that because you don't really have a comparable growth story at that profitability in their sector, right? And ARM, it's just like you have so many other choices that are growing that provide less value. So that's what kind of makes it uninteresting to me.
That last point you made is an interesting topic, is the competition within an industry. So Eli Lilly in the medical industry, you're saying there's no competition in terms of their innovation, growth, and profitability. But chips, there's so many companies to choose from, that it's kind of hard to differentiate yourself as a company within that space. I think that's an interesting point to leave off that topic on.
Yeah, I mean, I think that's the only thing that is like very relevant about all of this stuff is always just like what's the competitor, right? And we actually got UNH, not SRPT or LLY this week, because we've been trying to like reduce risk, because the market's been so up and down. And of course, like, it shows when you see something like this today that it's just like, yeah, okay, a good time to reduce risk. I've even been pulling out of a lot of my smaller cap shorts because I haven't liked the data there. So this definitely hurts less as a result of that. But yeah, it's like I think too many people invest based on chatter, right? And that's why we like social sentiment and we like things like option sentiment and momentum stuff that we are comfortable with. But I think that like the tough thing is then when you like go a little deeper on ARM, you realize the value's not there. And I think that's important. And thanks for the compliment on Prospero. Glad you're enjoying it, and thanks for coming to the live stream.
Yeah, good to see you. I'm not going to even attempt to pronounce your name and butcher it, but thanks for coming. Hope to see you here often going forward. We got some news about Apple and a deal that they are nearing, not with Google's Gemini, but with OpenAI's ChatGPT, to be included in iOS 18 and iPhone 16s. So we've discussed this story in the past. It seemed at one point like Apple may be leaning towards Google. So it seemed like Google stock kind of got, maybe that was priced in a little bit and it went down slightly today when this news was released. Do you want to talk about the dynamic now between Apple, Google, Microsoft with OpenAI, how that, leader in AI continues to shift between those companies?
Yes. I think that it's a very interesting little story. One of the things that I actually find particularly interesting about this story is that basically Google went up about 5% when the Gemini story broke. And it's down about, like, I think I checked, about 2.5% today. So that really shows you sometimes about how much more the market will like go towards positive news than react to negative news. I mean, earnings is its own thing, but it is kind of funny that you get that direct contrast of like, oh, like with Gemini and Apple, like it's a 5% up, but only a 2.5% down, even on like a weird day for tech. Like Meta's doing pretty badly, another big comms company that's ads dependent. So I think that part is pretty interesting. And then, I mean, one of the things, I was on a space this morning talking about this, and there was a good point made that, this could just be negotiation on Apple's part. They're price negotiating with both of them, and they're going to go with whoever gives them the better deal, which is smart. Like, you gotta see who, and it's possible that the reason that they went with like kind of the less established or less, good to go AI in the first place, Gemini, was that they thought they could get cheaper, but then OpenAI matched the deal and they switched around. But yeah, it's going to be super interesting. And then like what's kind of funny is AI, like Apple's announcing that they're making a bunch of new AI products. So like clearly they're waiting. They're waiting for their partnerships to go through and not developing on their own, which we said is a good idea because we keep talking about how they're bad at innovation. But yeah, I think it's a very interesting story. It's going to be very interesting to see who they go with, because I think another part of that story that's really interesting is the fact that Microsoft, like Google's kind of Apple's like closest competitor. I'd say, especially like because of Android devices, like it's the closest thing they have. You could say Samsung, but Samsung's not doing all that well as a company. So you'd probably say Google. And then like Microsoft is Apple's like old school enemy. Um, so I think that that's like a pretty I think that um that's a pretty interesting thing. Whoever they go with is going to kind of be like either an old school competitor or their newest closest competitor. So it kind of shows where Apple is as a company, where it's just like I can't imagine them the Jobs Apple going to one of their closest competitors to partner on a product and not build it themselves. Um, but yeah, I think that's an interesting part about the story. I'm going to transition to the questions. Um, the stock price already reflected. So one of the things about like what you're asking here, and I'm going to try to say your name, Venkatesh. We're going to go with Venkatesh, and you can tell me if I'm close or not. Is that actually the Prospero's most important metrics, upside, downside, net option sentiment? Those are all created based on the options markets, and they refresh every 3 minutes. So actually, one of the reasons they work so well is we've often seen behavior, and if you look at the time series charts, you can pretty often see our metrics out ahead of price. And that's because a lot of the times, and because we update so quickly, institutions are going to put on their options trades. And once they're done with their options trades, then they start buying the underlying security and moving the price to juice their levered profits, because you're going to make more money, higher percentage on options. So a lot of the times they won't be even buying the stock until they've entered their options trade. So that's where the Prospero metrics can actually frequently get you ahead. I would say nothing's perfect though. Like any metric, like our metrics signals, they work really, really well. I'd say better than most things, but nothing works all the time. And like even me, right? I'm about 62% accurate in my higher conviction picks this year, was about 60% accurate in the higher conviction picks last year. In our model portfolio that's almost a year old now, on 6/4, it'll be a year old. I'm at 60% on actually there, that's like almost 1,300 picks. So much higher churn, right? And I say all this where it's just like I'm a little better at using the signals. Like I have 20 years of investment experience, and even then I'm about a 60% clip. So like, yeah, nothing's perfect, nothing's right all the time. But there's a saying on Wall Street, like you're right 50%, 51% of the time you can start a hedge fund. So Prospero does do very well. And one of the reasons it does do very well is because we're so focused on understanding, tagging, visualizing institutional options trades as kind of like our primary value prop. A lot of the times we can be ahead of the market, not behind. Why did BABA fall off the short-term bull list? Well, BABA fell off the short-term bull list because the short-term bull list is a formula. So the short-term bull list is net option sentiment plus net social sentiment, and then upside has to be greater than downside, right? So if you look on the short-term bull list, all of those will be the equation being different. Yeah, BABA's social sentiment fell to 19, so that's why it fell off the list. That's not going to be enough to make it on the list. We can go and just take a look right there, and you can always like here, you get all the inside info on this. So Broadcom is a 74 option sentiment and 80 social sentiment. So that's the bottom, 154. Anything below 154 is going to be off. And that's generally like, I would say I rarely see things below, 140. 150 is a pretty good cutoff, but you could use that yourself. If you see 150 for net options, net social, that's normally a pretty good indicator that there's momentum behind the stock.
And how often does the short-term bull list update? Is that every 3 minutes as well?
Well,
Okay,
it's
yeah.
derived from net option sentiment, which is updated every 3 minutes, and then net social sentiment updates every 10 minutes. Um, so so basically, yeah, if they're on an off schedule, it's possible it updates more than every 3 minutes, depending on when it hits, when that
Hmm.
net social sentiment hits. But the
Yeah, so
list,
it's
anytime a metric updates, the list refreshes.
yeah, so that list is pretty fluid, it would seem like. So if Baba's signals went back up, maybe it could be back on it later today, even possibly, James. So got to keep checking that list and see which stocks are on it and which aren't.
We
Um,
actually had one person complain in the app store that our picks don't refresh, which is really funny. Because like sometimes, I mean, I think he might have been looking at the long term ones, and yeah, sometimes those like long term signals don't move around a whole lot. So yeah, sometimes that list will look will look pretty similar. But uh, we're very close to a release that actually is going to not only get price in, but have a little like visual when a metric updates. So it's going to be way more obvious that it's updating.
yeah, look out for that, everyone. Can't wait to see that in the app. Um, so next story of the day, inflation has been the boogeyman of the market for years now, ever since the pandemic, it seems like. Um, but we have, a lot of companies that seem to maybe have capitalized on that inflation too much with their prices in their businesses, and consumers are beginning to vote with their wallets and kind of turn away from some of these places. Maybe McDonald's is one of them. They're now working on a new $5 meal to try and draw some people back into their business that have been price sensitive. Do you expect that we'll see this more from companies going forward? As you know, we talk about it a lot. The troubles in the consumer and debt climbing and all of those things playing out at the same time. That the economy seems to be maintaining some strength, and there's just a lot of competing data and factors going on right now. But what do you make of that
Yeah.
move from McDonald's?
Well, I mean, I think it's super interesting, and I'll tell you a little funny story about how I look at this stuff, which is that there's a funny like there's a for anyone that's seen the movie Die Hard with a Vengeance, even if you haven't been to New York, there's a subway station near what I grew up with where there's like one of the bombs was planted in that movie, and you could see in the back there's this thing called Gray's Papaya, which is a hot dog shop, and basically they have this thing called the inflation special. That like for a long time in my childhood, it was 2 hot dogs for $1, and it's kind of funny because it's been that way the whole time. And now that's kind of my proxy. That's one of my proxies for inflation because it's getting up near $5. That inflation special now, or I think it's like two. It was like 2 hot dogs and a drink for $2, and they have these like nice pineapple and pina colada drinks or whatever. And I think it's getting pretty near. It's getting pretty near $5. But like, yeah, I say that story and it's kind of where my mind goes because like that's one of the most unhealthy things I ever eat, and that's more because it's like part of my childhood. I'll grab a Grace Papaya hot dog here and there. However, uh, I kind of think the same way about McDonald's. Where it's just like it's getting up there near like a regular meal at like fast food places, and I don't really go to McDonald's that much anymore. But I do other fast food here and there, and like I remember like I think I got like a 5-piece chicken fingers at Popeyes, and it was like $15 or something like that, and I was like kind of shocked because it's just like I think this is a major problem for fast food that it's a good thing that McDonald's is thinking about because it's like yeah like once you get up to like pricey levels, all of a sudden I'm thinking more about like do I really need to pay like the same like close to the same amount that I would pay for like a salad like to get these chicken fingers. It's like if they were cheaper, I like it was easier for me to sell myself on. Oh yeah, I'll get like a less expensive meal. It's like whatever. I'll like who cares if it's a little unhealthy. It's also delicious. But yeah, I think fast food places absolutely need to think about this because they've been like creeping up their prices, and they really rest on brand loyalty, which is a good thing to rest on. But you absolutely, we got to see. I expect it to do well if they can execute. Like people love the dollar menu. That was like a big thing for them for a long time. But I do also think just like getting a meal at $5 is going to be like a big important thing, especially as like some of these other like, fast casual places get closer to $20.
So we got a comment where they were talking about perhaps if people, voted with their wallets more, price gouging wouldn't be so rampant. Do you think some companies and businesses were kind of using the inflation as an excuse and maybe too much to raise their prices in the businesses, and we're going to see that, now with the consumer seeming to weaken a bit, kind of level off and maybe prices either come down or stabilize for, a couple few years going forward from here?
Yeah, I absolutely think that that people are going to be much more sensitive to it, because I think on the way up, when the economy is like healthier and people have money around, like that's not something they look at. But there is signs that there is tightening, and like McDonald's is smart to get out in front of it, because like they're going to need time, and they're kind of like, and a lot of companies have started to guide this. They're going to need to see this stuff coming through the pipe, and like having it ready to go by the time people are really trimming the fat, so to speak. Although McDonald's doesn't seem like a great way to trim the fat, uh, literally. Uh, I think that I think that we will. I think that we will see a lot more of that. And we covered a story, I think, where it was like where the cereal companies have started to like put more cereal back in the boxes, right, and keeping the price the same, things like that. Like I do think we're starting to see a lot of evidence that people are taking this potential consumer spending decline seriously.
And that's good for people, hopefully, going forward. Prices dropping, staying steady, or getting more for your buck. That's all good. And that's actually good for the inflation outlook, I would think, too, right? If all these companies are already making moves and prepping, that would lead me to believe that inflation would come down and CPI would come down soon, and the Fed wouldn't be worried about, cutting rates. Or actually, I feel like we should spin to that now, because I don't know if we've talked about that recently. There was a minute there a few weeks ago where it seemed like maybe even rate hikes were getting kind of thrown around, like they could actually possibly be put back on the table. Um, I think we've still seen the rate cuts extended farther, much farther than they were initially before this year. But what's your updated outlook on rates? I feel like we're in a better spot than we were a few weeks ago, where data was kind of going against us. Seems like a lot of recent data came in weaker or as expected. So the rate cutting schedule seems to be more clear now than maybe just a few weeks ago. Am I right in saying that?
Before I dive in on that, I actually just wanted to expand on sauce pot, like cover the last story and talk about like sauce pots. Uh, Sauce pot is someone's first name. It's anyway. I think that the problem with voting for your dollars frequently is like when you don't have a lot of good options, or all the options look kind of similar. I think that's a lot of what's being dealt with there. Um, and it's just like it's hard to vote like it. And I do think that's one of the things that I see as the future of business, like companies coming in that are actually like more interested in um, building good products um, for their customers, that really take care of them. So I think that'll be a better when people have more options. I think voting with your dollars will be something that is more of a realistic thing. Um, the other thing that I wanted to say, in terms of uh, that question, is that um, I definitely think that these rate discussions are just so kind of schizophrenic, because it really matters like if the market's going up or not. And at these times when like, if we go back a few weeks where, not only does the market look way healthier, but we didn't kind of have that hotter inflation reading, it does. It looks like maybe like, and we've talked about this all year, like Powell is going to raise or not cut, with all the slack that he's given, and a healthy market gives him more slack. Now, I think with some of this data that's come in since then, obviously the concerning reading, jobs finally looking like they might actually be hurting a little more and be more at the levels that you'd like to see at a cut. economic data can change that fast. And that's what I think that's what Powell always says. But I think the next inflation reading is going to be super, super important. And I can't really speak to if it comes in at consensus, I think this story of a cut coming is going to pick up steam, consensus or beat, right? I think if it comes in a little hot again, I think we're going to see, the back off of the rate cut happen again, and some tough days for the market until perhaps maybe jobs data comes in poor again, and we're right back in a better zone.
And that speaks to the gamophobia that you shared in your newsletter, right? Do you want to kind of discuss that for people that maybe didn't read it? And maybe I'll grab the newsletter right now and share it in the chat for people if they want to sign up for it.
Yeah, I read that as gamophobia. But yeah, I think we talked about it a little bit. But yeah, I think gamophobia, fear of commitment is like the joke that we made. And yeah, I think that's a lot of the data that we're seeing. In terms of just large cap growth being up one day, down another day. Small caps look like they might be coming back 2 weeks ago. Last week they were the worst, the worst performing. Growth one day, value another. It's just yeah. I mean, we made a joke about fear of commitment because I don't think there's many hedge fund managers might have fear of commitment with their third or fourth wife, but I don't think they have any fear of commitment when it comes to actually buying stocks. I think that was a little tongue in cheek what we're talking about in terms of just hey, it's hard. And people that follow the newsletter closely probably know that I don't even typically 4 weeks ago, I changed my strategy probably more severely than I ever have in a newsletter. That's not typical of me. I'm owning the first stock, JLL, and it's going well. That's a real estate stock that actually has higher downside than upside. I got it because net option sentiment was elevated and I wanted some real estate exposure. So yeah, it's a hard market to commit to one way or the other when you're basically seeing people, not wait very long to take profits, get spooked off of any piece of news, any earnings. So yeah, it's a hard market to trade other than what we're doing. And it's funny, sometimes people are just I've actually had a few people ask me that well, the portfolio, keeps going down, blah, 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 in terms of yeah, we were at 100 and we were at 140%. We're now down to 87%, maybe, a month and a half ago. But it's just well, you have to understand, if you're performing at 140% annualized above the market, even if you have some 60% weeks, that's going to lower 60% above the market, that's going to lower it. So yeah, some of what we're doing is just treading water a little bit, taking gains where we can, going pretty equal long short. And I think that's the best thing you can do in this market, other than apparently YOLO some meme stocks. But unfortunately, you're in the wrong place if you think we're gonna buy into that.
Do we want to cover this question we got again from Saucepot?
So do you think, I think that what I like to talk about a lot, I love the story of early Amazon. And early Amazon, Jeff Bezos had this thing where I was I actually like Jeff Bezos more when I heard this, because some people have found it very annoying, but he was just such a zealot. He would say you have to talk to the customer. He was customer first, you have to talk to the customer. All the early meetings in Amazon, there was a fake customer in a meeting. Or I guess Jeff Bezos thought that customer was very real. And you would have to he would be well, what do you think the customer thinks about this? And I share that story because that already exists. There are some companies how is Amazon so popular? It's faded a little bit in terms of their customer service, but amazing customer service. And they're famous for 2-day shipping. For those that don't know the story, they had no idea if they could do 2-day shipping when they started promising it. They were just okay, this is gonna be something that people like, our customers like, and we're gonna just try to pull it off, right? So I think that when I talk about Prospero's business model, and I talk about how long term we're gonna have wealth management products, but we're going to have wealth management products like built on community generated alternative data instead of hedge funds stealing data from people. We're going to work in tandem to make wealth management products, build our signals, get better signals from like our users that voluntarily give us information. But like, yeah, the way we're built now is that, right? We're putting a high quality product out there for that few other people have for super cheap, if not free, a lot of the features. And that's like a trend that I think we'll see more of, because I think people are getting smarter in terms of exactly what you're saying, in terms of like the planned obsolescence, blah, blah. And I think part of that is just the internet. It's very hard to get away with screwing over a lot of people in the same way where the internet exists. So I think that, it's kind of like, I always use this example, but I also think it's very similar of like the sharing economy. And I'm just like, I'm shocked when anyone takes an Uber, when anyone takes a yellow cab in New York now, as opposed to like an Uber or a Lyft or whatever. And I'm just like, why would you do that? And they're just like, well, you took cabs as a kid all the time. Why are you so against cabs? I was like, I'm so against cabs because you can't rate a cab driver, and they have no reason to like be a certain standard of treatment to you for that reason. And so it's like, and I think it's good. I think passengers should be rated well. I don't think people should be rude to cab drivers, and I don't think cab drivers should be rude to people. And I think that, that's like kind of what the internet gets you, right? It gets you a reporting structure of, a situation where you can't really screw people over on like kind of the micro scales that I talk about, or like some of the macro ones. It makes it harder, and you're fighting some serious headwinds these days. Like obviously Apple is a brand that has that planned obsolescence that I think if there was a new brand that did that, they would have a hard time scaling. So I think that's the new world that is being faced now. But I don't think it's going to happen overnight. I think it's going to be a slow progression. And I think some businesses are going to have to learn the hard way that, they have to start caring more about their customers, or they're going to lose businesses to upstarts in other areas, other verticals.
So one stat I wanted to definitely share today, because it's crazy, is I was reading an article and they were talking about the median home prices in the USA. So we'll start at 1965. We'll go through today. Ready? So 1965, it was just over 20,000. 1985, just over 80,000. 2005, up to 232,000. And now today, the median USA home price is over 420,000. So at the pace we're going, it seems like every home in America, or the median value one, is going to be over $1 million about 15 years from now. George, can you talk about maybe why home prices only move in one direction in America?
I had to get the yikes thing here. The median income is 37,585. So yeah, basically we're talking about 10 years. 10 years of salary to be able to afford the median house in America. And that's truly staggering. Sorry, what was well, the question was if houses were going to be, if the house price were going to be $1 million by, yeah.
Well, yeah.
I mean, I think there's supply questions on that, where it's just like what we might end up getting is just, more houses being built. I think part of it is what happens with cities, right? Because some cities are just getting so expensive that it's just like there could be moves to cheaper cities, and that would obviously, like, in essence, in some ways, like lower the median income, especially with like remote jobs. Like I think it's going to become more and more popular to go and live in a place where you can have more space and still have like that remote work. So I think that's the one force against it. But it's going to just be pulled up by the fact that it's just like there's got to be something done with the real estate laws. I mean, it's one of the biggest problems. And it's just like, we were actually, I was talking about this the other day, where it was just like I was even shocked because I knew there was some tax breaks that happened during the pandemic and some PPP loans, but it's still the case that you can leave your house, you can leave a home vacant and basically take that against your gains, if you own a lot of properties. And I didn't know that. And that's crazy because that could just basically allow you to like leave the rent in a, like at a certain price until you get a tenant. And that's like the antithesis of how real estate should work, as far as I'm concerned. Like, you shouldn't get tax breaks for leaving like a vacant property. You're leaving it at a price that it can't be rented at. That to me is insane, and to me it should work the opposite direction. Like, if like it makes more sense to me like to get a tax break if you rent something out at like below market value and you can prove that, right? Because you're creating less of a disjoint housing stock. You're meeting the market where it is. And you're not elevating prices beyond where they have to because you're just basically waiting for something to be rented. Granted, that's just like more red tape, and there's like so much like the crazy thing, the craziest like real estate thing that I always like do a real WTF at is like when you get FEMA funds, if you're in like a crazy flood zone, like when they're delivered to you, you are not allowed to use those FEMA funds to go live somewhere else. You can't be like, hey, this flood happened. Like, I need to go like maybe and live in a place that is not going to get flooded. So that to me is like, if we're talking about like the broken real estate system, that was a true shocker when I heard that one. I was like, do you not care about like you might be right back here, you might be paying to build a new house for these people. Actually, I should rephrase, forcing these people to build a new house in the place where their house just got flooded, uh and not letting them in a place like in some of these places, like you're talking about maybe 10 years at best before it floods again and you're writing another check. There's so much of those like there's so much of that craziness out there where I'm just like, oh God, how does this happen?
Yep, it's a crazy world. We have one more topic to get into before we'll be spinning it over to our model portfolio update. Hopefully, everybody will be sticking with us and joining us on the other side. But what I wanted to bring up is Warner Bros. Could possibly be losing the rights to the NBA. The contract is up for negotiation right now. NBC, Amazon, Netflix, YouTube TV, and Apple have all expressed interest. Warner Bros. Stock has been a dog. We talk about Netflix and Disney as the streaming stocks more often, but if Warner Bros. Loses the NBA, is their stock investable, George?
I gotta tell you, I've shorted it a few times and it hasn't gone well for me. So I don't know. I shouldn't bet against WBD. Like I see that like there's a few stocks that for some reason like they look good in the metrics, and like sometimes I've like gotten out of them and then they've done well. There's that's one of my bugaboos. But yeah, one thing I'd be curious about, I was like, oh, I wonder like when they signed that deal, what the deal was for and how long it was for, because I'm sure whatever it is, it's going to be way more expensive. Um, but yeah, that's going to be like YouTube should be the winning bidder on that. I mean, I'm saying they should because like they're starting to form a really good video platform, and they could kill cable if they could continue to acquire these like live sporting events, because that's the main reason like I should say my parents still have cable, which means that I have internet access to cable. Um, that is like keeping me. So like live sporting events. But like, yeah, if they manage to get like the NFL and the NBA, that's a huge draw to all the other program that they have. And it's like also like I've like signed up for it and got it because I don't want to pay for cable. And I think it's like $70 a month to start or like whatever, and I can stream things. Um, but uh YouTube makes it really easy to just like add a bunch of channels. Like they have a good product for that. Whereas like I remember back in Time Warner, you wanted to watch something and you called them, you waited on the phone for like a half hour. They're like, oh well, that sport channel only comes with our premium Sport Plus package. And it's just like, and then you're just like, it's $40 a month, like just to get that. And it's just like, but don't worry, you'll have ESPN 6, 7, and 8 with that. And it's just like, what a terrible business model. they had. Uh, but but yeah, I think that like that's one of the things that like I think there's probably going to be a point in my life when I'll get like YouTube cable again, just because like of how easy they make it to like modularly add things, and then if they get the NBA, it's just like yeah, I'd probably want to buy all those packages. And you just like the big thing that you have to like be like DirecTV really did something stupid was like they had all of that and they just like they kept their satellite dishes. They could have done a streaming service themselves. Like they had all the channels, they had all the rights, they had all the broadcasting. That was one of the dumber. And I remember with NFL Sunday Ticket, they were always like, you got to get a dish. Like finally, like towards the end of it, they were smart and they started to say, well, you can just buy it. But they really held out on people, and that wasn't very smart. They could have done a lot better.
Talk about YouTube. I'm always curious about what YouTube would be worth as a standalone if it wasn't, engulfed by the Google cover company. Because it seems like YouTube is really the leader in this. I mean, maybe Netflix you could say argue, but they're either one or two. It would be interesting for me to see if YouTube as a standalone would have a market cap as big as Netflix. But
YouTube, yeah, I know. I mean, I think they'd be a little behind, but the interesting thing that I will say about YouTube is that uh, I think they have the closest, even without what we're talking about, they have the closest thing to like what TV used to be. Like you just flip it on. There's a lot of people that use YouTube for that. Like I never just like flip on Netflix and throw something on, right? Like in fact, Netflix, that's why content is so important because sometimes I'll be like, I'll go into Netflix, I'll take a quick look and I'll be like, yeah, nothing for me. And I might even just decide, depending on like how terrible what it looks like, sometimes I'll decide not to watch anything at all. Just be like, oh, this is a bunch of garbage. Maybe you should find something else to do. But I do think that's kind of what's promising about YouTube because it's short form, they're mixing in some long form. I think they have the potential to have that just like I'll turn on my YouTube kind of thing that people used to do with TV. And like obviously they have really good AI. So that is the one thing that I think would be particularly, and like if they got the NBA, they have to drive more people, they can drive more value behind the product. But like I think that they could have a TV replacement if they do it right.